Imagine walking into a concert where everyone suddenly starts selling tickets at the same time. There are so many tickets available that prices begin to crash, and buyers get a much better deal. That is exactly what is happening in the bond market right now, except instead of tickets, it is IOUs from the United States government and corporations. This September, the United States government and a huge number of corporations are selling so many of these IOUs that it is like they are flooding the entire market. This is not a conspiracy. It is a simple case of supply and demand. And understanding this core concept is the key to understanding why the global bond market is behaving so wildly. Here is what you will really learn today. First, we're going to use this debt tsunami to finally demystify the most basic principle of finance, the inverse relationship between a bond's price and its yield. Second, I will reveal why a bond's yield is a more powerful indicator than you think, and what it tells us about investor psychology. Third, we will peel back the layers on how central bank policies like quantitative tightening are actually designed to create this exact market reaction. Fourth, we will break down the single most important chart you can watch, the yield curve, and I will explain what its current shape is secretly telling us about the future of the economy. And finally, we will connect the dots from the United States to India and show you why these seemingly domestic events are having a massive ripple effect across the globe. Before we dive in, if you want finance explained not just as facts and numbers, but as a fascinating system with hidden rules and logic, hit that subscribe button right now and join us. Every video is designed to give you the tools professionals use every single day. Let us start with that massive supply story. We are talking about a projected $140 to $175 billion in new corporate bonds hitting the United States market this September alone. Why does that matter? If you're the government selling IOUs and suddenly you need a lot more money, you have to find more buyers. To attract those buyers, you have to offer a sweeter deal. What is the deal on a bond? It is the yield. The yield is the effective return you get on your investment. So, when the market is flooded with new bonds, their price falls, and as the price falls, the yield has to rise to attract new money. This is a fundamental concept. Bond prices and yields move in opposite directions. When you read a headline that says bond yields are skyrocketing, it is simply telling you that the prices of those bonds are plummeting. And the reason they're plummeting is because there is so much new supply. This is not a market panic. It is a market recalibration based on a new wave of debt. Now, let us talk about the central bank's role in this. For years, the Federal Reserve's main policy was quantitative easing, or QE. That is when they print money and buy up government bonds, which creates demand and keeps bond prices high and yields low. But what is happening right now is the exact opposite. It is called quantitative tightening, or QT. The Federal Reserve is allowing its massive portfolio of bonds to mature and is not reinvesting the proceeds. This is a deliberate process designed to remove money or liquidity from the financial system. So, while the government and corporations are selling a record amount of new bonds, the biggest buyer in the world, the Federal Reserve, is on the sidelines. It is like having a big auction, but the person with the deepest pockets just is not bidding. This lack of a major buyer naturally pushes yields higher. You might be asking, why would the Federal Reserve do that? The answer is simple: to fight inflation. When you have too much money chasing too few goods, prices rise. The Federal Reserve's job is to make sure that does not spiral out of control. By pulling liquidity out of the system, they are making it more expensive to borrow money, which in turn cools down the entire economy. So, while you're seeing headlines about a bond market meltdown, what you are actually witnessing is the Federal Reserve's monetary policy working exactly as intended. This is a planned and calculated move to return the economy to a more stable state, even if it feels jarring to the market in the short term. Now, let us talk about a powerful concept that can help you see all of this coming: the yield curve. The yield curve is a simple line that plots the yields of bonds with the same credit quality but different maturities, say from a 3-month bond all the way up to a 30-year bond. When you have a normal yield curve, it slopes upwards, meaning you get a higher return for lending your money for a longer period of time. It makes sense, right? You get paid more for taking on more risk over a longer period. But right now, we are seeing something called a steepening yield curve. This means that long-term yields are rising much faster than short-term yields. What does this tell us? It tells us that the market is expecting more inflation down the line. It is also telling us that investors are demanding a higher premium to hold long-term bonds because of the risk that the Federal Reserve will have to raise rates even further in the future. The steepening yield curve is a flashing signal that the market's long-term outlook is shifting, and it is a critical tool for any financial professional to have in their arsenal. This brings us to a concept that most people have never heard of, but it is arguably the most important one today: real yields. We hear all about nominal yields, which are the stated interest rates on a bond. But what really matters is your return after inflation. That is the real yield. For years, as inflation ran hot and nominal yields were low, our real yields were negative. You were losing purchasing power by simply holding bonds. It was a crazy world, and it is what forced investors into riskier assets like stocks. But now, as nominal yields rise faster than inflation, we are finally seeing positive real yields for the first time in a long time. This is a game changer. It means you can finally get a real inflation-adjusted return on a safe investment. This is a powerful signal that the financial system is starting to return to a more rational state, where risk-free assets can once again offer a sensible return. Finally, let us quickly connect the dots to India. While the United States and Europe are dealing with these internal issues, India's bond market will feel the ripple effects. As United States yields rise, it puts upward pressure on bond yields in India as well. But here is the nuance part. This could be a net positive for India in the long run. Why? Because as global investors get spooked by the volatility in traditionally safe markets like the United States and Europe, they will be looking for stable, high-growth alternatives. India, with its strong fundamentals, can become a beacon for this flight of capital. So, the very same forces that create short-term choppiness in global markets could actually accelerate a massive flow of capital into India over the coming months and years. It is a fantastic example of how seemingly domestic issues can have a massive and sometimes surprising impact on other economies. So, the next time you hear a headline about a bond market meltdown, I want you to stop and ask yourself what is really happening. You now know that it is not a random collapse. It is a direct result of supply and demand, a deliberate action by the central bank, a warning signal from the yield curve, and a return to a world of rational, positive real yields. These are not just news stories, they are a live, real-time lesson in core macroeconomic principles. Understanding these concepts will give you a level of insight that most people will never have, allowing you to see the world of finance with a whole new clarity. If you found this breakdown valuable, make sure to like this video and subscribe to the channel. That way, you will never miss the deeper insights hidden behind the headlines.